A 6% fully taxable CD versus a 5.5% Treasury or agency bond, or perhaps a 4.6% tax-free municipal bond. Which one is better for you? Hello, members and super savers. I hope you're having a good week. Fully taxable, partially taxable, and tax-free fixed income instruments. That's what we'll be talking about in today's video. And specifically, here are the questions I'll be answering. How is interest on different types of fixed income instruments taxed? What's a quick and easy way to compare tax equivalent yields across different types of fixed income instruments? And what other important considerations should you keep in mind? This is especially important for our community, in my mind, as we move from less complex CDs and treasuries to more complex bonds, such as agencies, munis, and corporates, and perhaps, when the time is right, to high-yield bonds and even more. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. So as usual, let's go to this table that we created for all of you to clearly understand how interest is taxed on different types of fixed income instruments. This column shows the type of fixed income instrument we're talking about. And this column shows how the interest earned on a particular fixed income instrument is taxed. For CDs, certificates of deposits, interest earned is generally taxable on a federal, state, and local level. For Treasury securities, which includes T-bills, T-notes, T-bonds, I-bonds, TIPS, and floating rate notes, interest earned is generally taxed on a federal level, but not on a state and or local level. For agency bonds, interest earned is usually taxable on a federal level, and in some cases, also on a state and or local level. You can refer to the Simplify Your Agency Bond Journey table, and specifically to this column here, to see whether interest earned is exempt from state and local income taxes, depending on who the agency bond issuer is. Moving on to municipal bonds, also known as munis, which under certain circumstances can be completely tax-free. Interest earned is normally not taxable on a federal level, but in some cases, it may be subject to the alternative minimum tax. Income from some munis may be exempt from state and local taxes as well. For example, if you're purchasing a muni issued by municipality within your state. This tax advantage is also why most municipal bonds tend to have lower yields than CDs, treasuries, agencies, and corporates with equivalent maturities. For corporate bonds, interest earned is generally taxable on a federal, state, and local level, just like for CDs, as you can see here. Now, all of this here can be a bit confusing if you're trying to compare yields across the different types of fixed income instruments. So, let me show you a calculator from Fidelity that can help simplify your fixed income journey. So in this section of our video, I'm going to walk you through how to compare yields across these different types of fixed income instruments using Fidelity's fixed income taxable equivalent yield calculator for individual bonds. And specifically, we're going to answer the question I posed at the beginning of this video. Which is better, a 6% CD, a 5.5% Treasury, or a 4.6% municipal bond? Keep in mind before we start that with Fidelity's fixed income taxable equivalent yield calculator for individual bonds, the impact of federal and or state alternative minimum taxes, AMTs, are not reflected in this analysis. Click on this here if you want more details on how this calculator works. So from this pull-down menu, I'll select Certificate of Deposit. Here I'll put 6%. Let's scroll down, and here I'll enter my taxable income from last year's federal income tax return as an estimate for this year. I'll just put in $100,000 as an example. Now, I also have the option of not entering anything here, either because I don't know it or because I don't want to. In this case, I'd have to check this box, in which case Fidelity would then use the highest marginal tax rates for both federal and applicable state taxes. Also note that the highest rate will tend to favor tax-exempt bonds like munis. Let's scroll down further to the taxes section. Here I'll enter my federal tax filing status. From the pull-down menu, I'll select Married Filing Jointly. In this box, I'll choose my principal state of residence, which is New York. And here I'll enter my local income tax. I'll leave this blank for the purposes of this illustration. And then I'll hit Calculate. And voila, this table appears below, showing me that a 6% CD in New York State is similar to a corporate bond yielding 5.91%. And for those of you who are wondering why the CD and corporate bond yields are different, despite the fact that interest earned on both types of fixed income instruments is generally taxable on a federal, state, and local level, the reason is because with Fidelity's calculator, CD yields are assumed to be a true annual yield, reflecting compounding of interest, whereas bond yields are assumed to be twice the semi-annual yield, as is the normal convention for quoting bond yields, meaning compounding of interest is not reflected. So moving on, this table also shows me that a 6% CD in New York State is equivalent to an in-state municipal bond yielding 4.29% and an out-of-state municipal bond yielding 4.54% and a Treasury GSE yielding 5.5%. So going back to the original question, should I buy a 6% CD, a 5.5% Treasury, or a 4.6% municipal bond? What Fidelity's calculator shows me is that in this instance, I should go for the 4.6% municipal bond because it's higher than all these other equivalent yields here. Pretty handy for comparison purposes, right? Do keep in mind that if you're purchasing an agency bond from one of these issuers, which is taxable on a federal, state, and local level, then you should be referring to this corporate bond yield here, rather than this Treasury and agency GSE column, because this assumes that you're purchasing an agency bond from one of these issuers where interest earned is exempt from state and local income taxes. Now, if I go back to this tax equivalent yield page from earlier, I can see the federal tax rate for 2023 that Fidelity calculated, as well as the state tax rate for 2023 that they calculated. So, the next time you're trying to compare yields across different types of fixed income instruments, this fixed income taxable equivalent yield calculator for individual bonds may be a helpful tool for you. I've linked it in the description below for reference. Tinker with it a bit and come back and let us know what you think. At the time of this taping, anyone can use this calculator. It's publicly available. You don't need to be a Fidelity customer. And for those of you with the other leading brokers, do also drop us a comment below if your broker offers something similar. Now, there are a few things you should keep in mind about this calculator. So let's talk about them now. Here are some important things you should take note of with this calculator. 1. The yield calculations assume you purchase your fixed income instrument at par and that you hold to maturity. They do not account for any profit or loss, any capital gains that may result if you sell your fixed income instrument before maturity. 2. The yield calculations assume that you hold your fixed income instruments in a normal taxable brokerage account. So for example, if you were to hold your Treasury bills, notes, or bonds in a traditional IRA, the interest earned on those treasuries would typically be fully taxable as ordinary income upon withdrawal. You would lose your state and local income tax exemption, and this number would no longer hold. And similarly, if you were to hold your Treasury bills, notes, or bonds in a Roth IRA, the interest earned on those treasuries would be completely tax-free. So, moving on. 3. You should use this calculator for estimation purposes only. Remember, everyone's financial journey is different. Fidelity uses assumptions. In fact, all online calculators use assumptions. You can learn more about this calculator's assumptions by clicking here. And on the screen that pops up, we see the calculator's assumptions, some of which I've already touched upon. And down here, there are details on what the calculator does not account for. So if you do want specifics on yield comparisons across different fixed income categories for your portfolio, what applies to you only, do consult a tax or financial advisor who understands your individual goals, circumstances, and expectations. Personally, I've found this calculator to be a good first proxy for whether I should continue evaluating a fixed income investment or not. However, please note that while I have been using this calculator for my own estimations, I cannot vouch for its accuracy. What about you? Do you think you'll be testing this tool out? And if you have already, what are your thoughts? Or do you have an even better one to recommend to the community? Drop a comment below and let us know. All right, members and super savers, as always, I hope you enjoyed this video and learned something new. And I'd love to invite you to continue to support our channel through membership so that we can keep producing one-of-a-kind, unbiased, sponsorship-free videos for our super saving community. Get your top-of-mind questions answered in our next live member Q&A on September 22nd at 5:30 p.m. Eastern Time. And check out our latest member videos. Click the join button on our channel page or the link in the video description below for more details about Diamond NestEgg membership. As always, don't forget to share this useful calculator and video with the fixed income fans that you care about, and hit that thumbs up, and see you again very soon with more brand new wealth building content for your financial journey.